great turnout. Thank you guys so much for joining. I just wanted to, let you know my name is Larissa. I'm part of Baselane's customer success team, and this is our webinar on how to finance your next rental property deal. So just a little bit about who we are. Again, as I mentioned, Saad, if you don't mind just changing the slide in 1 second here. Thank you.
Sorry. Do you want to just do intros really quick and then we'll...
Exactly. So again, my name is Larissa. I'm part of Baselane's customer success. Here with me is Saad. Saad is our head of business development. He also is a rental property owner. And Saad, if you want to just mention a few of your rentals here and such.
Hey everybody, my name is Saad. I lead business development and partnerships at Baselane, and I'm also a rental property investor, mostly focused on the BRRRR method. Have been doing mostly long-term rentals for the last 5 years and recently got into short-term rentals. I'm on my second project for that, so let's see how that goes. But excited to talk to you about lending and how to finance your deal, next rental property deal.
Awesome. And we also have a guest speaker today, Robert Larcara, who happens to be my father, but also he is the president of Pacific First Equity Services. He's a mortgage broker, mortgage lender, and real estate broker with over 40 years of real estate experience and real estate finance experience. Hi, Dad. Hi, Rob.
Thanks. Hello, Larissa and Saad and everybody. Nice to be here.
Yeah. Thanks for joining. And it's so awesome. Like, I know this is very unique too, that it's Larissa's dad and he's here to give us all his knowledge and share information with us. So thank you so much for joining.
Thank you.
Exactly. And I'm also a mortgage expert. You'd say it's in my blood. I do always like to mention that. So before we get started, I just wanted to give you a little intro on, the agenda, what we're doing here. So we'll discuss a little bit about Baselane. This is going to highlight the topics of discussion. And then there's, of course, the Q&A that we'll leave for the end of the webinar, but also we'll be answering questions throughout the webinar as well. So please feel free to ask any questions whenever you'd like. We're here to answer and kind of guide. And also, just like for some housekeeping, this is being recorded. So we are going to share this recording when it's done, as well as just notifying you that it is a recorded webinar. Again, feel free to ask questions in the Q&A. We will be answering periodically, and we'll do our best to answer when the question has been presented. But of course, we'll also be looking at the different questions at the end of the webinar as well. So that being said, I'm going to give it to Saad to kind of go over our first topic, the different ways to fund the rental properties. Or what is Baselane? Sorry.
Yeah, thank you so much. And we can, by the way, you can all chat here with us and let us know if you have any questions and comments as you go. That will be helpful. And we are going to be sharing some polls that are going to be going out starting now. And basically, we're just trying to learn more about you so we can better contextualize the conversation for this webinar and make sure that you're getting the most out of it. So please engage on that. Would love to get 100% participation and get your input so we understand who you are and where we can help you. In terms of just giving you a quick overview of Baselane, so this webinar is being sponsored by Baselane. Baselane is an all-in-one banking and financial platform that helps you manage your rental property finances and your rental properties. We're very passionate about educating our customers, so that's why we're bringing you this free webinar on lending, but there will be a lot more that we'll offer in terms of other webinars, and there's a lot of educational content that we have as well on our website and our blog page. So what is Baselane? So Baselane offers a business checking account that is custom made for real estate investors and landlords with no fees, no minimums, high rewards, 4.46% APY as of September 2023, and up to 5% cash back. We offer online rent collection for free for you and your tenants. We offer you bookkeeping so you can, in a simple way, track all your numbers and make sure you stay on top of that. And we help you with tools that help you analyze the cash flow and really understand what's going on with your portfolio. And we're building a lot more. So yes, there's free wires right now, free bookkeeping, free analysis. We've also got a free rental property deal calculator on our website under our resources section. So lots of things that can help you not only get started, but also to run and scale your real estate business. We want to be with you throughout the whole journey and from 0 to 100 units. So that's why we're here. If you have any questions about Baselane, check us out at baselane.com if you're not already a customer. And yeah, I think there's some polls that were shared.
Yes. So it's a great thing to kind of see, you know, a good amount of our audience today owns, you know, 1, even 4 to 10. There's a lot of individuals here who are just getting started. So it's great to have you and really excited to learn more about, you know, your interest. It seems like there's a lot of individuals looking for midterm, long-term, short-term. Actually, we have a great amount of participants looking at all types of investments, as well as, you know, where they are in the buying process. It looks like a lot of them are getting started and just trying to learn their loan options. We do have a few that are making offers and even some that are under contract. So really excited to see where this goes as well.
Okay, with that, that's helpful information. I think we'll try to talk, Robert, more a little bit, not just about your traditional long-term rental, but maybe I think when we say short-term and midterm, you know, midterm is the traveling nurses type rental, and then short-term is more of your Airbnb type corporate housing, maybe, and some other things like that, Verbo. So we'll keep that in mind as we go. And I think this is, you know, meant to be an intro to how to get money or put together the right funds for your lending. And so we're going to cover this in a bunch of categories. And we actually structured this in 4 categories you can see here. And the first category is focused more on, you know, some of the things that you can do before maybe even getting a loan. And we always like to start with that because maybe perhaps you don't need a loan, right? Maybe you have other ways to get to the deal in the beginning to get your first one done or your second one done. And so maybe I think what we'll do is start here. I was actually going to share my experience, but maybe Robert, I'll open it up to you. Category 1, we've got personal savings, we've got friends and family, we've got partners and joint ventures. What is kind of your thinking and your advice for people on kind of approaching, you know, the how to fund their rental property deal with the first category that we're looking at here?
Well, you know, cash is king, and it always is good to come in all cash if you have that ability. Number one, it will give you a lot of leverage in terms of the purchase price. If you're coming in all cash and you can close quickly with no contingencies, it's a great thing. A lot of people also are, you know, getting together and pooling their money, family, friends, where they'll put 3, 4, 5, maybe up, you know, 5, 10 people together and purchase a property, income producing property, and grow from there and start a, you know, property management company. And you know, that again, that's coming in all cash and pooling money together. Always a good thing. And partnering on a joint venture where you have somebody come in with you. Maybe it's another property management company, real estate, somebody who understands the market, and you pull your money together and partner. So those are great. Probably the best way to buy real estate. But not everybody has that luxury, or they can come into a, you know, cash deal.
Absolutely. And I did want to share, yeah, this is super helpful. I think, like, again, if you can start here and combine category 1 with 2, right, in terms of like how you put the deal together, that's another way to think about it. I mean, sharing just a rough example of kind of how I did it was obviously starting with some personal savings. And, you know, we'll talk a little bit about the ways to do this, but I think a lot of discipline of just putting money together over time and having a plan. If you have the luxury of going to family and friends where they can invest with you or give you a loan or maybe even give you a gift, that's another way to go about it. The kind of thing that worked out for me was putting my own savings together, but then also partnering 50-50 with another person. And I brought 50% of the cash. So just a rough example is, you know, let's say you're going after an entry-level deal that's worth $100,000 in terms of purchase price. You and your partner can bring in 50-50 in terms of the cash, for example, and you can buy it outright in cash, right? That's one way to do it. The other, there's many different approaches, but you could also just partner together and put down the 20-25% required from a lending perspective. And that only requires, let's say, 10-15K from each person. And then you could take that remaining that you have and put it into a rehab or improving the property so you can, you know, increase the value. So there's ways to do this. I would definitely recommend heading over to our Baselane's blogs section under financing to read more about the different specific types you can go after, and we're happy to walk you through that more. And we'll talk about how we can help you after this call in terms of a follow-up. So
Yeah,
that I think we want to, yeah, go ahead. Sorry.
yeah, I'm sorry. Sorry to interrupt. I just want to bring out one other point. When it comes to traditional lending, if you don't have all the funds, a lot of younger people are, going to their parents and getting gifts for the down payment. And that makes a big difference too. Lenders have no problem with a gift from a family member. So if you don't have a down payment, that's another thing that works. And I think that kind of falls into this category.
That's a really great point, because even with the traditional loan, as we're getting into category 2, you do need to have what, depending on the loan type, 5 to 20% down on the purchase.
Right.
Right?
Yes.
That's a really good point. And just to clarify with the gift, how does it work? Like, what do they need to do to actually get that gift in terms of the tax side? Is it just a letter that states, person A
Uh,
is giving person B a gift and so on?
well, yeah, it has to be a family member, close family member, a mother, father, sister, brother, some cases aunt, uncle. You have to get a gift letter. The gift letter has to specifically state that it is a gift and there's no repayment needed. And then they want to see 2 months bank statements from the giftor, through the person who's giving the gift. So showing that those funds are seasoned. It's
That's
basically about it.
I'd also like to mention just a really quick thing. Getting a check is probably the easiest way, because the check is going to have the gift donor's details, and you don't really have to. I did this quite often in my previous
Well,
job.
that's another thing that, in terms of the process. So
Yeah.
you get the gift letter, you get the bank statements, and then you got a paper trail, the
Right.
deposit, whether it's, a check that goes into your account or if the money is wired directly into your account, but it's all got to be paper trail.
It is paper trail. And the easiest paper trail, I always say, is get the check. It's less information to get from the gift donor. They don't have to share their bank statements, because it's going to share on the check the actual details of the donor, their name, their account. They can correlate. So it's really a simple way. But that being said, I'm also going to launch another poll here to kind of have an understanding of what the audience would like to talk about as far as the different loan, as far as the different ways to fund. So which loan category would be really beneficial for you to learn? Or maybe we can dive in a little deeper, since there's 4.
Yeah,
So feel free.
On the screen, you can see category 2, 3, and 4, and we're giving you the option there of category 2, 3, and 4, since we just talked quickly about category 1. And I think, for Robert, there are folks here who have already done a deal, and they're also thinking about doing their next deal. And there's already a question about how much should I have in reserves for my next investment. There's one person here from, it looks like, I'm not seeing this today, but they're asking that's another question that's being asked. So I think we'll start into category 2. I don't know, Larissa, you're already seeing responses.
Yes, I've seen responses. A lot are going for category 2, and some have gone for category 4. So I'm going to end the poll now, but it's between 2 and 4.
Okay, great. So this is where I think, Robert, we can dig in. So maybe I think let's talk about it with sort of your first deal as one way to look at it for traditional and non-conforming and private money in category 2. And then we can come back and talk about how to do your second deal with that. Maybe just kind of thinking about that.
Sure.
So I'll ask you. So, I'm looking at category 2. I put some money together, however I got there, friends and family, my own savings. Now I'm, thinking about making a deal, my first purchase. I'm making offers. How do I think about traditional lending versus, what we call conforming loans versus non-conforming loans versus private money?
Gotcha. Okay, well, first let's take a look at traditional loans, what they call conforming or conventional FHA, VA loans, which we'll talk about a little more in detail on category 3. But your traditional loans, they require source of down payment. In other words, that's got to be paper trailed. It's got to be seasoned for at least 2 months. You also have to have, in some cases, if you're self-employed, or if you're an employed, a W-2 employee, you'll need W-2s for 2 years and 2 years tax returns, and a month worth of pay stubs, 2 pay stubs usually.
Got it.
just to show that, you're employed and this is the income that you're making. And you also, they put a
Yeah.
heavy emphasis on credit as well. I'm sorry, go ahead, son.
Yeah, so basically on this one, it's more of your personal income based
Right.
underwriting. Is that a way
Yeah,
good?
exactly. And it's when they say it's traditional, it's truly traditional. In the old days, that was the only programs that were available. They take a look at your debt to income ratio, how much debt you have, how much income, to see if you qualify. And that's done by reviewing your tax returns, your W-2s, and your pay stubs,
Got it.
and
So that's a
what debt's
traditional loan,
coming up on your credit report.
right? And that's
Also,
probably
it is also, I'm sorry to interrupt, it's also important that you have good credit on traditional loans. In your Fannie Mae, Freddie Mac loans and conventional loans, it's good to have a score above 660. If you have a 720 score or higher, you're golden, and you'll get better pricing on your interest rates and payments, and you'll also have a little more flexibility on your debt ratios.
God, that's super helpful. What about non-conforming loans and private money loans? Like, before we even jump into like, well, maybe we'll talk about what they are if you can help us understand that, and then also, why should I think about those loans versus the
You
traditional loan?
know, everybody is different, and every borrower has a different loan scenario. Again, if you're a W-2 salaried employee, traditional loans are probably where you want to go. You're going to get the best interest rates there. If you're self-employed and you are, or a 1099 employee, and you deduct on a Schedule C, or you're self-employed and you get money from your corporation, and you're not showing a lot of money in terms of the IRS, or you're taking heavy deductions, the best thing to do is go with a non-conforming loan, and those are what they call non-QM, non-qualified mortgage, where you can use 12 months, 24 months, 6 months bank statements. They're a little more lenient on the income. You don't need tax returns, you don't need a pay stub, and you don't need W-2s. They'll go strictly off the bank statements and what you're actually paying, like if you have an office rent, car payments, things like that. Then there's also what they call a DCSR loan. That's a loan where if you're buying a specific income property, they don't care about your income, where you're working, what you're doing. They're looking specifically at the merits of that investment, that property. So if it's say a duplex, and you're getting $10,000 a month, and your mortgage payment's $5,000, you're making 50%, a return, you would qualify. They'll go up to 20%. If you're 20% profitable after you look at your mortgage payment and the taxes and insurance, you'll qualify strictly on just the merits of the rental, of the rents
How about
coming in.
yeah, and I think we're going to go deep into comparing traditional and non-traditional on the next page in more depth and
Mhm.
detail, but then
Oh,
we
and
can talk about
I
private
want to
money.
just say one more thing.
Yeah.
I'm sorry. On the non-conforming and also traditional, we're talking about only 1 to 4 units. So anything above 5 units, you get into a different arena. That's 5 units or more. That's commercial, and that's more like traditional bank financing or private money.
Gotcha. Got it. So yeah, headed into that, there's maybe, I think a lot of the verbiage could also be clarified. So what exactly is private money, hard money? Is it the same thing? Is it different? And where does that usually come into play? Because I've seen like fix and flippers using more of this, what we call the private or hard money loan, for example, as the bridge.
That Yes, and this is basically that the source of that money is from private investors. And then there's mortgage lenders who work directly with private investors. Sometimes they pull the funds. Sometimes they just find a high net worth individual that is going to lend and get a pretty good yield on their money. It's private money is usually 10 to 12% interest, sometimes higher depending on the loan scenario or the property and the borrower. And then there is also, they're short term, maybe 1 to 2 years, give you an opportunity to buy the property, and the down payment is much higher. The loan to value is they'll only go up to 65% on a loan. So if you had a $1 million property, they only go up to 650,000. Not like your non-conforming and traditional, where you can go up anywhere from 5 to 20% down. This is more like 35% or more.
Generally, you're required to pay a lot. You need more cash up front, and I think there's also some that have reserve requirements in terms of cash. That's needed.
Yeah, and the underwriting is extremely lenient. They're only looking at the their equity position. They're at 65%. So if you default, they're not going to lose any money. They'll come back, and their money is pretty safe. It's very well leveraged.
Yeah, and there are some questions in here. So guys, we'll get to the questions in a bit here towards the end of this the slide that we're going through here. Question a little bit on the more, not the short-term rental side, because there are people who are interested in that. How does that fit into this equation if you're trying to get, financing for Airbnb type property? Are you seeing, is there paper that's written out there for Airbnbs outright?
Yes, I'm sorry. Yes, it is starting now. There are lenders that will, in your non-conforming loans, they'll look at that. If it's not a long-term rental, if it's short-term housing, like you said, with doctors or nurses, or your, Airbnb type of properties, there's specific loans that are available in the non-conforming market and private money.
Yeah, and actually we're, Baselane has been investigating that for our customers. So if anybody's interested in that, we are kind of testing one partner out. They're not really somebody that we've announced yet, but we're working with them. I'm actually personally trying to see if I can use them as well, to see if it makes sense for one of my STRs. And if you're interested, you can reach out to us, and we'll definitely try to connect you and see if that works out for you. Because I think, Robert, now there's also like all this additional data, like Air DNA and stuff like that allows those lenders to analyze the value, the cash flow, and things like that on the short-term side.
Right.
We're going to go into more of the traditional non-conforming type and like some things in the next page. FHA and VA, I think we're just kind of maybe talk about it for 1 minute, and then get into category 4 a little, because there's some interest there. So maybe you can talk about FHA and VA, like who do you see coming in for this type, this type of loan in terms of rental properties?
Well, if you're a veteran and you can get in with 100% financing, you don't have to come in with any down payment. It's great if you're going for an owner-occupied property, but if you come in at 100%, sometimes the property is not going to debt service. So you got to come in with a down payment and structure your purchase where you're going to have cash flow. But that is available on VA. They don't really care that much about credit. You could have a 560 credit score and still get approved. They are concerned about income, and that the property is going to debt service, and that you've got enough income from your job or employment where you can cover. But it's a pretty simple loan process, and it's a great opportunity because it's 100% financing.
Yeah.
FHA is traditionally 3.5% down. So, you got a 96.5% loan. It's a very small down payment. There's also loan programs in different areas here in Los Angeles and California. The state and the county here, different counties, subsidize the down payment. So it's down payment assistance programs where you can, again, get in with 100% financing.
So I've got a question for you on that one. Let's say, what if you already have like an addition, current, you bought a owner-occupied rental property already with cash or some other financing. Are you still able to get an FHA on your second deal, or is it only for the first deal?
No, you can get FHA also has rental properties. You can do non-owner occupied loans with FHA. Down payments more. You're looking at 20%.
I see. Is FHA yeah, sorry, go ahead.
I was going to say, with the 3.5% down payment, if you buy a duplex, you live in, or 1 to 4 units, if you live in one of the units, then you're okay. But it's got to be owner occupied, and then the other three will help you cash flow.
Got it. And
That's
there's a PMI on that, right? If you're obviously under 20%.
Yes, and that's the other thing we should talk about too. With FHA, you have mortgage insurance, PMI, private mortgage insurance. It's crazy in the sense it doesn't benefit you. You're not insured. The lender's insured basically for the down payment for that 3.5%, and it's pricey. There's a formula for it, but it's a few hundred. Basically, you can figure it's somewhere around a few $100s a month.
Got it.
To whatever based on the loan amount.
Yep, that's it. I want to spend a couple of minutes on category 4 before we take a look at some of the questions and see if we can answer some of those questions. Category 4, this is getting a little bit creative now, right? I think we're getting into the realm of creative, and there's the debt equity lending, which you shared with us, and the seller financing. Can you talk a little bit about each one? Like, what is it? When should you be thinking about using it?
Okay, well, debt equity financing, it simply means that you'll find an investor who will actually invest in the property with a loan. In other words, that's the debt. So you got $1 million property, you could have an investor come in at 65% loan to value, 650,000 in debt, but you only have 20% to put down. So that's another 15% that you're going to need as a down payment. Well, if you find an investor like that, they're far and few between, but they do exist. And they like the project, they'll put that additional 15% into equity. In other words, they'll have 15% ownership equity in the property. So they have debt of the loan, and then they have an equity position to cover the difference of your down payment.
Got it. Just to make sure I wrap my head around it, can we do it with the $100,000 example? I'm not.
Yeah.
I don't know
Okay,
if we're doing the $1 million level deal
100,000.
yet.
Okay, so
if
you've
we
got
got a deal for
$100,000 sale, right?
Yes.
And you're looking at an investor that will lend you, a private investor that will lend you 65% of that 100,000. That's $65,000.
Okay.
You only have 20,000 to put down. You're
Right.
short 15,000. So the investor will say, okay, you know what? I'm not that leveraged, but I really feel comfortable with the property. I feel as though it's going to cash flow. You'll be able to pay me. I'll put the other 15% in as equity. I'll be a partner of yours for a 15% interest.
Understood. So
that's
65.
Another $15,000.
Gotcha. So 65,000 or 65% of that 100K deal is the debt that they're giving you as an investor. Then you're bringing cash 20,000 in that example, and there's a $15,000 gap, and they're saying, "Hey, I'll come in also as an equity investor, the same person, and give you 15K, but in exchange for that, I want equity."
Exactly.
Gotcha. And
So
what
they'll
kind
take a position. It could be 15%, it could be less. It's negotiable, but that's a debt equity scenario.
Got it. And then seller financing, I'm assuming folks do know a little bit about what it is, but could you tell us quickly what is it? And like, are you seeing seller financing out there? Is it happening?
It depends. It's usually when it's a buyer's market and sellers are desperate, they'll carry back. If it's a very brisk market and it's a seller's market, then normally you don't see it that often. But what it is let's say you only have, again, let's just use that $100,000 scenario. You got a purchase price of 100,000. You need 20% to put down. You only have 10%. So you put your 10% down, that's $10,000, and the seller will carry back an additional $10,000 in a second position. So you have a loan amount of 80%. You put 10% down, and the seller will carry back a second, or finance a second at 10%. So you have an 80-10 loan.
Got it. And what's like the motivation for the seller to want to do that? Why would a seller want to get involved when they're trying to, sell?
Sometimes they're just motivated because they want to sell the property and they're having a hard time selling it because of the market. Another time is, they're going to get hit with capital gains. So if they lend out some of that money, they don't get hit with capital gains on the money that they use as that second mortgage or carryback.
Got it. That's helpful. I think I personally never been able to do seller financing, although I've tried to negotiate it a few times. Definitely takes some skill and effort to figure out, how to structure it the right way. There's a lot of
Yeah,
pros
and a lot of it has to do with market conditions and the market that you're in. If you're in New York or you're in LA or, bigger city and the market's brisk, it's difficult. But if you go out to smaller, like smaller towns, smaller cities, and there's a bigger demand or a big demand, less of a demand for housing or investment, there's a lot of times you can work with people. And
Yeah.
especially, now that the boomers are getting older, like myself, they've got a lot of equity in the property and they don't want to get hit with a heavy capital gain. So a lot of times it's to their advantage. Their CPA will tell them, yeah, carry back some paper on the property and get a
Yeah.
yield.
That's super helpful. So we're going to take some of the questions and go through them. And before I do, I do want to mention, like, I think it's so important to have the right person, on your team, whether it's your lender, in this case, to talk through these options and figure out what's the right mix for you. But also, like you mentioned, a CPA, somebody who can coach you through some of these things ahead of time and plan for it, if you're in a selling situation. So a couple of questions have come in, and I'll try to, just mention, the theme of the question and see if we can answer it. So if one person's asking if they already have a deal done and they're collecting rent on it, how much, should they be saving up in reserves in terms of the next deal that they're going to do. So they're saying that, trying to avoid putting down 20% would help, but they're also trying to figure out how much cash reserve to have for the next deal, basically. And when should they be, what is the target of the next time they should start, do the next deal?
It's a good question. And like I was saying, beginning of our conversation, every scenario, every borrower is different. So, and every loan scenario is different. So based on the first purchase and how it's cash flowing is going to determine, do you want to go into another property? Are you ready? I would say, just to be safe, it's always good to have 6 months reserves. In terms of underwriting on a loan, the lender wants to see in conventional, like Fannie Mae, Freddie Mac, you're looking for 2 months reserves. If it's FHA, they'll go with 1 month reserve, based again on your credit score and how the algorithms come out and how they feel their comfort level with you as a borrower.
Got it.
So
So
I think I
basically,
answered that question, but
when you say it's
it's
reserved,
really on kind of case by case basis, and you really got to analyze, what you're doing. The devil's in the detail on this. But yeah, go ahead, Assad. I'm sorry.
I'll just make it, I'll just give an example, right? So I got my first property. I bought it for 100K. I'm getting $1,000 of rent on it. I'm cash flowing a little bit, let's say $200-300 a month, maybe a little bit less these days with the rates. Now I'm saving up money. Let's say I've got like 10K saved up. I know I need to buy another one for 100, right? The minimum 20%, 25% down requires 20 to 25K, right?
Mhm.
And so the way I think about it is like, look, well, first you got to save the money, right? You have to have enough cash to invest in the next deal, but you don't have to do it alone, right? So if you can bring capital from other places like we talked about here, there's definitely ways for you to move faster in the deal instead of waiting around for a year to save up another 20, 25K. Maybe it's bigger. So you can find ways to accelerate the access to cash by doing some of these options here, right? And get the deal done. That's what I would say. I mean, the other thing is, it depends on your strategy too, right? Burr method, if you're buying and rehabbing and uh, then you're renting it out and then you're refinancing and repeating.
Right.
And depending on the type of seasoning you got, you can move through that deal in 3 months, get a lot of your money out, cash out refi, and get to the next deal, for example. That's what I focus on. There was another question here related to that, which is once I've paid cash for and rehab my property, does that meet the requirement of a cash out refi?
If you're pulling cash out, yes, it would be a cash out refi.
Does
And
it
that's a
require,
good point.
yeah. Sorry, does it require them to have a lease depending on the loan type?
Yeah, well, they want to make sure that the property is cash flowing, and so if you just rehab the property, again, depending on the loan that you're going for, if it's a private equity, private hard money loan, you're at 65% loan to value. If you've built that much up, a lot of equity, like you've bought a property for, like you said, 100,000, you rehabbed it, it's worth 200,000. Well, now you're at a 50% loan to value. You can go up to 65%, so you can get 15% cash out with no problem. They probably wouldn't even ask for a lease, because it's equity based. But if you're going for a conforming or FHA type loan, yeah, they're going to want to see that the property's debt servicing, or that you can at least cover the negative on it based on your income.
Got it. That's helpful. So the debt to equity ratio really matters, just to summarize, in terms of the loan to value ratio, sorry, that you're getting to on the deal, and the valuation, the appraised value of it, right? As
Right.
well as potentially the cash flow. So the answer to that is not straightforward. You have to talk to a lender and let them take a look at your property and see, what makes sense, basically. There's another
Right.
question here in terms of Baselane and our program, what states we're in, as well as can we do e-signature? So the partners we work with can do e-signature. So they have like a more of a digital process. So yes, we can do that. And what states we're in, we'll send you some information with the full list afterwards, but we're pretty much in all the large states. And Robert here is in California, and some of our other partners are national. So they're in 30 plus states, all the big ones. So we'll send you that as a follow-up. I think we can definitely send you that right after. And there's a couple more questions. How do I separate my name from the business? So there's a few more questions here. I'm going to move to this topic and try to cover that in this discussion here in terms of like some structures. So we're talking a little bit about non-conforming loans and conforming loans side by side next to each other, and comparing and contrasting them here, because that's really where most of the action happens. And so, Robert, if you can help us think through, again, some of the specifics here, that would be helpful, because I've always done more non-conforming because I have an LLC, I'm titled in the LLC, the property's titled under the LLC, the loan goes to the LLC. I mean, of course, there's personal guarantees that I have to do, right, on that loan. The business is not as seasoned, let's say, for 5 years. And obviously there's folks that are doing the conforming, right? There's a limit, I think, in the US on how many you can do.
10, yeah.
10 maximum. Okay. So could you talk a little bit about this in more detail? Maybe we start with non-conforming. Like, what are the advantages of the non-conforming loan?
Again, it's a easier process in terms of underwriting and qualifying. You could go with bank statements, or you could go with just the rental, the market rents for the property that's the subject property. So you don't really need all the documentation that you'd have to have for a FHA, VA, or a conforming Fannie Freddie type loan.
Right.
And it makes the underwriting process is easier. The interest rate, that's one of the pros. One of the cons is that you're looking at a higher interest rate on a non-conforming loan than you would on a conventional.
Got it. If I have properties that are on my name, and let's say they're paid off, or whether they're in conforming loans today, and I'm trying to move them into an LLC, how does that process work?
You can, as you should talk to your lender. That would be the first thing you do, and explain your situation. Normally, it's not an issue. If you already have an existing loan, it's in your name. If you read the note, there's a due on sale clause if it transfers over to another entity or another person. So you want to clarify that. You also want to make sure that you're doing it correctly, where you're not going to get reassessed in property taxes. It's very important.
Not show it as like a sale, maybe, or like a reappraise, for example, depending on
Right, where they reassess the tax liability. Also, you should just talk to your lender and tell them you're an investor, you want to put it in an LLC, and normally you don't have a problem with that. It's usually pretty simple.
Is it typical that you have to reclose on that to move it over? Or is there a way to move it over without reclosing and paying all the closing costs and all those things?
Oh, no, you can, no, it's just a quick claim or grant deed over to, from you to your LLC.
I
It's a
see.
recording fee, basically, or you work with the title company
Okay,
and
so
make
if
sure.
you have, got it. So if you, let's say, have already titled the deeds into the LLC that you created, how does that work? Like, what changes the situation now? Can I get a conforming loan now for those properties that are sit in the LLC?
Uh,
Or do I have to go with non-conforming?
Non-conforming is not a problem. Conforming, you're probably gonna have to take it out of the LLC and put it into in as an individual. But then as soon as it records, you can put it right back into the LLC.
Got it. Okay. So is that okay to be able to record and then change it back, or is that
Yeah, it's not a problem. Again, it should be disclosed to the lender, so everybody's on the same page and they understand it, so there's no issue later.
got it? That's helpful. And then, we are talking a little bit about how to do more deals. We have one deal, we want to do the next deal. So there's another question here about being able to use equity from an existing property that is owned 100%, let's say, or you have 80%, whatever. How can you leverage that to go and either redevelop or buy something else by the
Well,
next?
one is the cash out refi like we were just talking about. That's one way. The other way is you could cross collateralize. So if you have another property that you're buying, you'd put the loan in the name of, the loan would be encumbering the new purchase and the property that has all that equity.
Okay, there's I'll add a layer of complexity to that now. What if you're trying to change that property from one unit to that same property that is paid outright? You trying to get equity out of it, but you're also trying to convert that same property into a duplex or a triplex legally. Does that cause any issues with lending in terms of like, hey, I've got 100K of equity over here. I want to take out, X% and use that to flip this thing into 2 apartments or 3 apartments.
No, it shouldn't be a problem. If you're taking cash out, at the time you're taking the property, you're refinancing the property in a cash out refi, and it's a single family residence. That's how they're going to look at it. Now, after you get the loan and it closes, and you decide that you want to, go get plans, permits, make sure that the land is zoned for another 2 or 3 units,
Yeah.
or 1 unit or whatever, then it's okay to do that. Then you have the cash to do it, and that's fine. Normally, it's not an issue. I've never seen it as an issue. I've never seen that happen.
Yeah.
The big thing though is you want to just make sure that you're doing it to code, and that you've got a certificate of occupancy, and that you're going to finish the project. So you're going to take out enough money, and you have a contractor that can get from point A to point B and actually finish everything. So you're not stuck in the middle with
Yeah.
half a property or half a.
That makes sense. One question here, I think we may have miswritten something here. So for a DSCR type loan or a more of a broader category, non-conforming loans, definitely I think you can do residential property. But is it possible, I think what was meant to be here is that, can you do owner occupied? Or does it have to be, just a,
No, good question. On a DSCR loan, where they're just going off the market rents, it's got to be non-owner occupied.
okay, so that was the intention for this. You can do residential, 1 to 4 units.
Right.
That's possible, but you cannot live in it. And
I have never done one. I believe that that's a pretty stringent guideline. However, I would say this: if you do have a property where it's going to debt service, it's such a got so much income coming in, and you live there, and it still meets the market rents, there may be loans like that. Honestly, I don't know of one at this point. I've never seen it, but logically it makes sense. I believe the underwriting guidelines are pretty stringent, though. It's
yeah, I have
not
not.
occupied property.
Correct. So you can do 1 to 4 residential, However, you cannot have owner occupied. I haven't seen that either
Yeah.
myself, trying to do like loans. So okay, I think that's helpful. Yeah, generally here, from our perspective, the lenders that we work with, they offer both options for you guys. So if you're interested in exploring, what makes sense for me from a non-conforming perspective or conforming, we can bring you both. And like I said, on baselane.com/loans, or we'll follow up with an email on that. So you have an idea of how to, talk through this with someone and understand what's the best option for you. Yeah, I think we just want to summarize this here and just jump to the next topic. So definitely, like, you were saying, understand your situation first, uh, your income, assets, credit score, etc., to figure out where you best fit, find the right loan type, and really for the right strategy, depending on what you're doing. Are you doing fix and flips? Are you doing rentals? Is it STRs, right? It can vary depending on what you're doing and the number of units, of course. Get qualified for a loan, and then definitely apply for a loan or at least one deal. That was a pro tip that we had from you, which is like, make sure that you actually try to have a real conversation, even on a real deal. You can have a hypothetical, but bringing a real deal is better to see what the numbers will look like and kind of play the whole, process out. So let's move on to the next page here. I think, Larissa, you're going to be taking us through it. So I'll keep an eye on the questions and over to you.
Oh, thanks. Thank you both for the discussion here. So in this slide specifically, we're giving you just kind of a preview of the loan process overview. And I really wanted to focus more with Rob here about the benefits of being pre-qualified. I think in this time, as I continue to learn more about this industry and wanting to invest, there's always a topic of, are you pre-qualified? So I'd love to know, like, why, how, when. So I'm going to let you kind of take it away, but I think it's important that we kind of highlight the pre-qualifications and the benefits and when to start.
Right. Yeah, pre-qualification is, going and meeting with the lender before you enter into a contract is imperative. Because otherwise you're really putting the cart before the horse. So what you want to do is meet with your lender and fill out a loan application, bring all your documentation so everything can be reviewed. And in some instances, the way that I do it here in my office is we will actually get an approval for you through designated underwriting, or sometimes even through a physical underwriting process where you're approved for a loan amount with X amount of a down payment, and the subject property is to be determined. So you want to make sure that you're fully qualified and that you're not going to have a problem. When you're going into escrow, you're going into under contract, and then you can't close. So it's very, very important to know exactly what you qualify for.
Got it. And I've also heard, oh, sorry.
Just to add here, I know we're talking about like first-time buyers, but can you talk a little bit about second-time buyers a little bit more? Because there's a lot of questions here of people asking about different scenarios.
Sure.
If they have one deal already done, they have paid off deal, and so on. Right? There's a lot of questions about what if I've got it paid off and I want to do cash out refi? What's the alternative? What's the right time to do the next time, the next deal? There's a theme here. So could you talk a little bit about the pre-qualification process and relate it to that too?
Sure. Again, even if this is your second, third, or fourth, or you're a savvy investor, you want to know what you're going to qualify for. What the property is going to qualify for. What kind of a loan program are you going to do? Are you going to do a DCSR? Do you qualify for, a Fannie Mae loan or a Freddie Mac? Your conforming loans or FHA. You want to determine what your game plan is. How you're going to move forward and purchase that next property. And if you've identified that property, you got to, when you're talking about non-owner occupied properties that are cash flowing, you want to make sure that you're putting enough of a down payment on the property where it's going to cash flow and you're not going to be in a negative. You're going to be profitable.
So
the other side of that too is if you see a property that, like you said earlier, if you're going to maybe do a rehab and add another unit or an ADU, a granny unit. It's going to increase the property value. It's going to give you more cash flow. That's, another scenario that you want to look at. But again, it's all in the detail, and each each loan, each property, and each borrower are different. So you got to really drill down and analyze the total picture.
Got it. Thanks.
Yeah. So summarizing it, like you have to talk to your lender. It's a back and forth active conversation, but also you have to understand your analysis and run
Right.
your numbers when you get that information and see what it looks like in terms of performance and NOI and net cash flow to make sure that's making sense. So all these things matter when you're talking about when do I do the next one, or how should I do it, for example. Sorry, go ahead. I think we're coming up on 6 minutes of time. So maybe Larissa, we can jump into the next one and then
Sure.
questions. It seems like there's a lot more questions here still.
Awesome. So, we kind of wanted to highlight just positioning for loan approval success and more so like talking about today's market. I think really what's going on in the market is a bit different and, would love to kind of do a deeper dive briefly on some of these points specifically that would make for a good borrower. What makes a good borrower in today's market, and maybe touch on improving financial stability, this business plan. You've discussed this a few different times. So I'd love to kind of hear, how is today's market? What is that looking like? What do you suggest for investors with the market today?
Well, generally speaking, in terms of the nation, in terms of interest rates, we're in a pretty stagnant market, simply because there's more buyers and less sellers. So that's keeping the prices relatively stable. Every, market's a little bit different. But the reason there's any stability is because rates went up so high. Most people refied during COVID at 2.5%, 3% interest. So if they're going to go buy another property, you're looking at 7%, 6%, somewhere in that range. It's doubled. That's on an owner-occupied, scenario. So right now, there's not a lot of property on the market. So it's supply and demand. So the prices are pretty stable. It's more of a seller's market right now than a buyer's market. As rates start to go down, I think you're going to probably see a little bit more leeway, a little more product coming on the market because people are going to sell and go buy other properties, maybe downsize, or maybe buy another property. And again, when you're talking about rental property, income property, like we're talking about, it's really the specific deal. If you're buying something, you've got enough of a down payment where the property is going to cash flow, or you see the opportunity to improve the property with a granny unit or additional units. You're going to improve the equity position and get better cash flow. That's really what makes sense. So you got to look at every deal separately. But the market right now, it's stable. We're not seeing a big crash. I actually thought we were going to crash when rates went up to 6% at beginning of last year. But because nobody's selling, doesn't make sense to sell when you're at 3% and you're going for your next property at 7%. So
right, and
that's kind of holding everything up.
Yeah, we're also at high, like all time, like in terms of rent levels, we're also at pretty high rent levels in terms of the price.
Yeah, that's also true. Yes. Out here, demand for housing is a big issue. A lot of people are moving. A lot of people are actually moving out of areas too, and retiring. I see properties are still strong here because people are coming to California and the Southern California area because of foreign investment. Hedge funds are coming in and buying properties, and a lot of people are moving out because of the cost of living. It's very expensive here.
Yeah,
so, and every market's different.
I think basically, since we're coming up on time, we can extend it for another 10 minutes if everybody wants to stay on longer, because there's a lot more questions we haven't gone through. If you're okay with that, Robert,
Sure. Happy to do it.
Awesome. And I think on this one, Larissa alluded to it, the solid business plan. Robert, let's start with this one because it leads to a lot of the questions people have, I think. What are you looking for as a lender, right? When somebody comes to you and wants to talk to you about doing a deal, financing a deal, we're talking about this business plan here. The word business plan is kind of nebulous. We could say deal analysis, right? You could say the like kind of presentation you put together for your deal, what do you look for from an investor when they're coming to you and asking you questions about their first deal, second deal, third year? What kind of business plan or numbers or information are you asking them?
Well, basically, we need to get income in terms of the borrower, credit, the credit score, their debt, their current debt, and their income. And how do we determine all those factors, right? So let's just start with the property itself. If you're buying a property for $100,000 and you're getting $1,000 a month rent, but your mortgage payment with taxes and insurance is $1,500, you're at a $500 deficit. It would be a difficult loan to do unless you're making so much money that you can compensate for that.
You mean,
So,
does that mean like you're in your income, your W-2 or your job, you're making
yeah,
enough money to cover the
would
debt?
have to be able to cover the deficit. So
I see.
again, every scenario is different. So, generally speaking, when I'm looking, a borrower comes in and says, hey, I want to buy a property, whether it's owner occupied or non-owner occupied, I need to pull a credit report. I need to see your income documentation. And then I need to review the property. If it's a rental property, what the income is and what the sale price is and what you're coming in with as a down payment and how much reserves you have. Those are the four elements to putting a loan package together.
Perfect. Larissa, should we go through some of the questions here and make sure we covered all the questions?
Definitely. Yeah, so one is, it looks like you had answered this, but I think it's a good one to also have Rob do. But when is the best time to cash out refi and when should you not do it?
Good question. Well, the time to cash out refi is whenever you have if you need to do something. Sometimes you can refinance just to consolidate your debt, where you're overextended on credit or what have you. I've done a lot of refis for people who just, got high credit card debt, they've got high car payments, and we can roll that into a 30-year fixed rate at a decent interest rate. And, then they have a better quality of life and less stress on making those monthly payments and cash flow. That's one. If you're in a good scenario where you don't need to cash, you need to cash to consolidate debt. Yeah, but you see some kind of investment like another property. Hey, I've got $200,000 in equity. If I can pull out $200,000 in equity and I can use that as a down payment, then it makes or pay all cash for another property and get a 12% yield on that money. That would be another time to pull cash out. But I would never pull cash out to go on vacation or do something like that. Let that money work for you. And that would be the reason to pull money out.
And I'll share with this too. Like when we talk about cash out refi, it depends on your strategy, right? So that's why we go back to the business plan. So do you have a business plan, right? Do you have your real estate business plan that says, hey, I'm going to go and do 20 deals in the next X years. This is how I'm going to fund it. This is going to be my target number of units that I go after. This is the area that I'm focused on. This is the kind of renter that I want to focus on bringing in. And this is the kind of performance I expect over the next 5-10 years. Do you have that plan? And if you have that plan, then you go with the plan. So for example, with me, I'm trying to get to a certain number of units. So I'm always doing burn, I'm always doing cash out refi immediately as soon as I can when I qualify. So that means when my property is rehabbed, it's rented out, I've got leases, I'm already working with a lender in the middle of construction saying, hey, this one's coming up. I want to order appraisal. What are the loan terms? I want to refi out as much as I can. And I want to use that to get my next deal. Why? Because my plan is to get to a certain number of units as long as the math is working in terms of the cash flow. So that's what I do. I don't have a question mark. I'm going to do it as soon as it's rented out and the lender gives me the money. And if you ask me in this environment, does it still make sense? It's much tougher. The net, the NOI and the net cash flow is lower, right? Because of inflation, because of higher interest rates and higher insurance costs, it is lower. But if it still cash flows, you can keep moving. And or you can get creative. You can mix it up with some short-term, midterm rentals. You know, one unit is STR, the other one is long-term. You can do things like that to balance it out. So when you borrow now at 7.5%, you're justifying that spend because you're going to go put it in another deal. And I'll say maybe, Robert, like, I mean, like, how do you evaluate that? Like, do I go do a cash out refi at 7%? Do I get a traditional loan at 6.5%? Do I go borrow money from family? Like, that's kind of what I would look at, right? Like, look at the options you have to do your next deal. You can refi at 7.5%, whatever the rate is today. You can go do a traditional loan without refining, put some extra money down. You can go borrow from some private investor, maybe cheaper than the refi rate, right? Are there other ways that, you know, are there other instruments you can use to do cash out refi other than doing a cash out refi?
You know, again, it's kind of goes back to the beginning of our conversation. If you have the cash to buy and you don't need cash, don't refi. You know, you have equity in the property. But like you're doing, you have a game plan. And again, it's a business plan. You know that you want to acquire X amount of properties in X amount of years. So if you rehab the property, you can pull out some cash to go buy your next property. That's your game plan. So, you know, if you're right now, we're in a high interest rate market, right? So, you know, maybe you're at 7.5%. But if the rates come down to 5%, like they're predicting, like some experts are predicting in the next 18 months, well, then you refinance that out. Now you have more cash flow. So is it a good time to buy now? If the property is going to debt service and it's not, and if you have to even put in a little bit of negative, you know, cover a little bit of negative, and you know that in a couple of years, hopefully the rates come down, it may make sense. But again, it's all specifically what you want to do and what your business plan is. And that was, and everybody is, you know, each loan, each borrower, each scenario is different. It's all kind of like an art form.
Thanks. Cool. Quickly, you know, DTI ratios for conventional versus non-conforming. Non-conforming is it 1.2 times for PITI, or does it vary? PITI is principal, interest, taxes, and insurance, by the way.
Yeah, when you're talking about debt servicing, or if you're talking about qualifying, it all works out to about a 45% debt to income ratio, which includes PITI, your principal, interest, taxes, and insurance, and your debt, your long-term debt, credit cards, car payments, student loans, personal loans, that type of thing. Whatever's showing up on your credit report. You want to be at 4. So if you made $1,000 as an example, your DTI, your debt to income ratio, couldn't be more than 45% of that gross income. And that's gross income, not income after taxes. It's before taxes. Also, the other thing you want to look at is, you know, if you have better credit, if you have a 720 credit score, a really good credit, and you know, this is all done with algorithms. If you know, the underwriting looks good, like you're a good, you know, good borrower, you have good pay histories, they'll work with you. You'll get maybe a 46%, maybe 47%. Sometimes I've seen with FHA, I've seen it up to 57% of a back end ratio. So it really depends on the borrower, your credit history, and income.
And my experience recently has been that with one of my local lenders, it went up from 1.15 to 1.2 on a loan, right? That change, I think, about maybe 8 months ago or something like that. They raised the requirement when we went to do a cash.
That's on a DCSR loan you're talking about. Like where you're looking at the market rents, they're looking at about 1.2 now. It was 1.5 at one time. 1.2.
Yeah, I mean, that one I have is with a local credit union, for example. And they went from 1.15 to 1.2. And I have to say, like, the cash flow matters. You've been emphasizing the whole time. When we do the next deal, they ask you for your rent ledger, your P&L for all the existing properties, right? So it's you know, this is why I'm highlighting this slide here for anybody who's going deal number 2, 3, 4. Well, how do you know your numbers? Do you have your Excel sheet put together with all that information the lender wants to know about your existing portfolio when you do your next deal? This is where Baselane can help you. We can help you organize all your finances. We start with the banking, which is the center, but then you have the bookkeeping, which allows you to then generate these reports and show your lender how you're performing on that deal when you're trying to get your second, third, fourth, 10th, 20th deal. So I just want to highlight that. I think a couple more questions and then we have to wrap it up.
I got one more quick thing I want to interject. You
Yes.
brought up a really good point. When you're looking at your income, like if you're, an investor and you have, a few properties and they're not in an LLC, they're in your personal name, you're going to have a Schedule E, which is all your, the gross rent from each property and all the deductions, and sometimes your accountant will deduct aggressively and it'll make it look like they're not cash flowing. You got a negative, so you don't have to pay so much cash. It kind of offsets your income. That's great on one hand. On the other hand, when you go to qualify for a loan, it looks like you don't have the income and you won't qualify. So that's a whole nother scenario that you have to look at if you do have existing rental property.
That is a super, super tip. I've actually personally made that mistake myself and gotten hit with it. And I think it's super important. Again, with Baselane, you can, with our bookkeeping, you can organize the expenses directly onto a Schedule E category. So you're on top of it. So you're not rushing to do it at the end of the year. You're planning and monitoring the whole year. But unless I think it's in the depreciation number, right? I think there's some things that they allow you to take care of, right? Like,
Right. Yeah, you can take out the depreciation.
correct.
But you still have your tax. Well, that's actually double hit. But if you say you put a new roof on, or you've got maintenance, or you've got gardening, and whatever you put in there as a deduction, and if it's taken away from the cash flow, it makes it look like you're in a negative when you're really in a positive.
Right. Meaning if you don't amortize the right way and don't do the right if you put it in a repair to accelerate your, taxable income, or like lower your taxable income, but it should have been amortized or depreciated,
Right.
then you might get hit with the lender saying, well, this is not performing. I'm going to raise the pricing or the rates or the requirements for your next deal that you're trying to do. And also it's a track record issue right now. You're showing a deal that's underwater. That could also be a problem. So really good point. I think maybe Larissa, one more question and then we can wrap it up.
Cool. The last question here, and if we can't get to the questions here, we can always follow up with you. The last one here is this different for commercial properties? So is this scenarios that we've talked about, or the loan process, is it quite different for commercial versus, residential or duplexes, things like that, multifamily?
Yes, the answer is yes. And when you're doing more than 5 units, it sometimes doesn't really work out. They use a cap rate and capitalization rate to determine what the income is after all your deductions and everything. And if you have a 20-unit building, larger property, more units, it's a lot different than on a 5-unit building. So sometimes it works, sometimes it doesn't. But yeah, bankers specifically use a different guideline on that. So and again, it's the units itself. When you say commercial, is it going to be a residential apartment building? Are you talking about commercial, office space? Automotive centers. There's a lot of different ways to determine value and income on those types of properties, which is a longer conversation.
Yes, I guess we'll have to have another webinar on commercial real estate. We have a lot of customers out there that do that as well. So, I think for now, this is a great way for us to kind of share some knowledge on this industry and how to get started, or if you already have. We really appreciate all the questions that you've presented. They've been really awesome to kind of go through, and thank you, Rob, for volunteering and joining us today. as a recommended next step with Baselane, like we highly recommend, checking out our banking. We offer free business checking accounts with 4.65% APY. And as Thad has mentioned, we have integrated bookkeeping. So not only are you banking with us, but you also are able to bookkeep for your financial, for your investments and really streamline your finances. So that way you have a clear picture and idea and have what we like to call a business plan to present to your lender. Also, check out baselane.com/loans as there's an option for you to apply for different loans. And you can reach out to Success at Baselane if you want to be introduced to our partners like Simplest, Lendency, and of course, Rob here from Pacific First. If you are interested in properties in California, he is offered kindly to answer questions, to guide, and of course, I'm happy to connect you guys directly as well. So thank you all for joining us. We will send this recording, and thanks again.
Thank you,
Awesome.
everybody. Have a good one.
Have a great rest of your day. Thank you. Bye-bye.